Hey there, everyone. My name is Ryan Schul. Welcome to my data science channel. I started this thing back in, October 8th, 2024. And I have been adding, on average, one new video every day since then. Sometimes, I'll be honest, sometimes I take a little time off. I think one day I posted 10 in a day. There's been a couple of days where I posted probably 7. You can see me wearing the same shirt sometimes in some of these videos. So on average, I try to do one per day. And my self-imposed goal is to get up to 365 videos by, within 365 days by October 8th, 2025. So that will be my 1-year journey, creating mostly data science videos. I go off on a couple small tangents here and there. This one, I think, is definitely in the data science wheelhouse, but it's not like the traditional machine learning, artificial intelligence, deep learning, data science types of topics like this, but there's definitely some overlap between this and the data science world. This is focused a little bit more on financials and specifically mortgage pricing and mortgage analytics. And we're going to go through a general overview today of what this is, how these things are priced, how they're managed, how they are analyzed, and how they're viewed by Wall Street. Okay, I think this is pretty interesting personally. And even if you don't, you should probably be aware of this stuff. We had a mortgage meltdown in 2008. It was a global financial crisis because some people decided to package toxic securities, or basically securities that really couldn't receive a rating. These were subprime mortgages. Some of them were sold as, I think, AAA or AA at least. I think some were sold as AAA, and it was absolute garbage. So some people bought these, had them in their portfolio. Some people didn't even know that, and they lost a ton of money. And it was an unfortunate event, but you know what? The more knowledgeable you are and the more aware you are of your surroundings, it's called situational awareness, the better you can protect yourself either in the physical world, right? If somebody is creeping up behind you when you're walking on the street and it's late at night, or in the financial world or business world or just academic world or data science world, the more you can arm yourself with knowledge and equip yourself with accurate, tried and true information, then the better off you're going to be, the better decisions you can make, the more informed decisions you can make, the more accurate decisions you can make, right? So you always try to look for insights from complex data sets. So I think this does fit into the data science world for that specific reason, but it's mostly a financial topic. It's not just general data science, but I think we can kind of like shoehorn this thing into the data science space just for our purposes today. So let's get on with it. Some of the videos I do, I know it drags on, it goes on and on. I've got some feedback about that. I'll try to make it tight and crisp from this point on, but I do have to lay the foundation initially too. So by studying mortgages and pricing analytics, we can understand mortgage loans. And this is a huge part of the financial industry, right? So going back to the mortgage crisis of 2008, a lot of people weren't aware of these things, and it really worked to their detriment. If you understand this, you can sidestep these pitfalls and make intelligent, informed decisions, and you won't be caught up in that global financial crisis, meltdown, fiasco, whatever you want to call it. Okay, so it's imperative to focus on the following items when you're looking at mortgage pricing and mortgage analytics generally. We look at risk management processes. What else? Profitability, consumer pricing, prepayment and default forecasting, mortgage-backed securities. These are MBSs. How they're sold in the secondary market, impacts of macro factors. These are things like unemployment, interest rates, federal funds rate, things like this. So these are macro factors that could impact the prices of mortgages, MBSs, and things like this, right? Regulation and compliance, stress testing will come into play at some point, maybe not directly for you, but these regulatory bodies are monitoring these types of assets and who's buying and selling these assets and the transactions behind these things, right? So they try to protect us if we can't protect ourselves from these people on Wall Street that sometimes try to do bad things. Most people are good, but there's some bad apples out there too. Mortgage pricing refers to understanding interest rates, fees related to mortgages, like interest rate fees, right? I have a 30-year mortgage on my condo, so the interest I have to pay every month is a fee assessed on my mortgage, right? And that's the cost of doing business. You have to pay that, and I think it's worth it. If your house is appreciating, it's most definitely worth it. You pay a small percent. Maybe I have about 2.85% interest. I got it way before the COVID crisis. Fortunately, we're really in the right place at the right time, my wife and myself. But I couldn't anticipate that kind of thing. But now interest rates are much higher, to the degree of 7.5 to 8%. It kind of depends on which state you live in, but that's kind of like the going rate now. So there's fees associated with these, and can the borrower afford the mortgage payment? And that's another factor to consider. Mortgage analytics involve the use of financial models. We'll see that towards the end here. Performance risk and the value of mortgage portfolios, and this is critical for investors and anybody that's going to buy these MBSs or be associated with these things. You can have an IO, which is an interest only payment, PO, which is a principal only, or any kind of combination of anything out there, right? They're carved up into countless different tranches, which can be repaid very quickly or not quickly at all, right? You could be right at the top of the tranche repayment or right at the bottom, and the interest that you receive on these tranches is according to, or is synced up with, like the riskiness of the investment and the tranche placement and how the payoffs come back to you, right? So I have some mortgage data here. Let me take a quick look at this and show you what this thing looks like. Did I actually move it? No, it's right here. So here's the loan data.csv. I got this thing from this website. If you go down to the end, I'll show you. It comes from here. So you can go to this and download the thing right there. So that is the source data explained where I got the file from, because it's not coming from online or some kind of just made up source. Like, this is freely available from Kaggle. And if we go and open this thing, okay, it's loading up. Oh, it's a big file, 17% done. Okay, so this might take half a minute or so to load up. Let's continue on, trying to keep these pretty tight and crisp. So I load the data from the CSV, okay, and I'm printing the columns. So there's about 120 different columns here, quite extensive. We can see the ID, the target. So this would be, this is a unique ID. It's almost, what is it called? Anonymized, right? This is anonymous, so I can't tell who this customer is. I don't know this customer or that one. But you'd probably have an individual name or corporation or business or some type of like text name. This is just a number identifier that is, so you can't identify who this person is. This is anonymous, right? And the details are obscured away. But there's some kind of mapping table, I guarantee. So the mortgage issuer or the mortgage borrower, well, the borrower is the consumer, like yourself and myself. The issuer has some kind of mapping table where they can convert those, right? So here's the ID. Here's the contract name. This is cash loans, revolving loans, the codes. Okay, so that is mortgage specific. I don't even know what some of these things are. Client children, not sure about that, but this is the amount of income total. This is the amount of credit. So that is the loan here. This is the amount earned by the borrower. If I put some format in this, might be a little bit easier to see. So this guy borrowed 406,000. Household income is 202,270. They borrowed 1.2 million, 67,000. Borrowed 135. 67,000 household income. Borrowed 80,000. So I can almost pay off the mortgage. But I mean, you have some expenses, grocery bills and utility bills and stuff. So you can't pay it off in 1 year. But this guy's pretty close. This guy's a little bit more leverage. That guy has twice as much leverage. You see the loan amount is almost the same. This guy borrowed, or his income is like almost half, I guess half of that, give or take, whatever. So this is more leverage. This is less leverage. And you have the amount annuity, that is the amount paid each period. I think that's what that terminology refers to. It could be slightly different with different issuers. Anyways, you have quite a few columns here, right? So we have to analyze a bunch of these, not all of them. It's 122 together. I don't think we need all of those. Some of those are superfluous or extra or unnecessary, but we'll use the ones that we need, right? So there's total assets. This is the amount income times 5. So annual income times 5. So we're saying, like, take your annual income, multiply that by 5, and that's probably your household assets. This is a little bit arbitrary, but I think that's a good guideline to follow for the most part. If you earn 100,000 per year, you probably have $500,000 And assets, if you household income is 200K, you probably have about $1 million in assets. That's how we got that. The debt to income is amount of credit divided by amount income total, right? When this one right here matches this right here, so those are the same. That's the household income. Amount credit over total assets. You got total assets over here, and this is the calculation. Let me import this, okay? Control Enter, and I'll refresh it just so you can see how everything works. I'm not just copying and pasting things in. It's all linked back to this CSV file. So that is done. Let's take a look. So we have a couple quick calculations. Control Enter to refresh the view here. And it just takes a second or so to run. And we have that. Slide this over to the right. And we have the new metrics that we're calculating. So total assets, debt to income, and loan to value ratio. So this doesn't come in the data set, but it's pretty easy to derive these. This is called feature engineering. We're creating new features or new columns from existing features. So total assets, again, multiplied by that. This is credit to total income and loan to value ratio. So we're creating new features from existing features, okay? So now we can create a couple more features: implied interest, loan term years, affordability index, and then is this a high risk loan? If the DTI debt to income, I think that's debt to income, is greater than the loan to value, and debt to income greater than 0.40, and the loan to value is greater than 0.8, that's high risk. If it is not greater, this is medium risk, and everything else falls into a bucket called low risk. Let me Control Enter to refresh this, and we'll see the risk categories again. Feature engineering, creating new features from existing features to help us analyze this portfolio of loans a little bit more accurately than just with the features that were given to us, right? We had 122 columns, but sometimes we need extra columns that don't come inherent in the data. We can calculate those on the fly, right? And generate a more accurate type of analysis for this portfolio of bonds. So we have risk category high, medium, and low. Okay, let me refresh this. Days employed. So that is when the when the loan owner, working days employed is greater than 365. This is more stable, so more than 2 years employed. Days credit update is, let's see, payment days credit update divided by 365. If days credit update in columns, then we use that else 0, and we have debt to income. So you can abbreviate that DTI or whatever. I like to spell it out. And then loan to value ratio, we got that from over here. Remember, so everything is pretty much linked here. Loan to value ratio, debt to income. So it's pretty tightly intertwined, and you really can't start taking these things out. You don't want to take them out, right? Once it's set up, you just run it. But you have to be careful the initial time when you do set up, just to get the spelling right and to get the logic right. But this is all done for you, right? So you don't really have to do a whole lot other than load the data and then run each cell one by one. Okay, so this is refreshing. I love my Mountain Dew. I just realized yesterday, less than 24 hours ago, Mountain Dew is one of the top 10 sodas enjoyed worldwide. One of the most tastiest beverages after Coke, I think, is 1, and Pepsi is 2, and Mountain Dew is right up there. It's like top 5, I think. So probably number 1 in my world, but Coke and Pepsi kind of like outdo the Mountain Dew people like myself just a little bit. So okay, so we have the debt to income, and we are creating a credit score here. So the credit score wasn't given to us, but again, we're creating new features from existing features and expanding the features we have available to us so we can make a more comprehensive and holistic analysis on this portfolio. So let's slide to the right so we can see the original came in total assets. Debt to income is calculated, loan to value ratio, implied interest rate, loan term in years, affordability index. Risk category, we just saw that, and an estimated credit score. So ideally, you want to have the credit score for each of these households, but if you can't get that, you can derive it pretty accurately using this formula that I just gave you. Okay, so debt to income divided by loan to value, and you have a multiplier here times 100 to get it into a percent, and then employment stability, right? So these are all contingent on the riskiness of the borrower. If they have less than 365 days of working, it might be high risk. Maybe the guy just started work out of school or was unemployed for a little while. You want to see consistent and persistent income streams, so it's a lower credit risk to the bank. Okay, so we can create credit scores because it wasn't given to us. Prepayment risk, again, another column we have to create because it's not given to us, but that's fine. We can derive that from the data. So Control Enter to run. And now instead of looking at 120 something rows, I'm just looking at these relevant rows. I'm adding here prepayment risk, default probability, loan to value, loan debt to income, and then default risk. So again, we have all these things over here, but there's a lot. It gets a little bit overwhelming, so I'm isolating it just to these newer features that we just added right here. So prepayment risk, 1 means yes, 0 means no. So it's true or false, it's binary. Default probability, that's no, 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 no. So these kind of like flip, although this one says prepayment risk and default probability. Because they could prepay the loan early. So that's a whole nother thing. I could get into a whole nother lecture about that. So if you buy a bond, you don't really want the person to prepay the money. If interest rates drop, they might pay off the mortgage and get a new mortgage or a new loan at a lower interest rate. But now you, as the mortgage owner, because you buy these prepackaged securities, right? Once they are issued to the homeowner, they're repackaged by investment bank and sold. But if interest rates have come down a lot, now you are supposed to lower interest rates, and you have to take that money that you got at an accelerated rate, much quicker than you expected. You have to reinvest that at a lower interest rate environment, so that's not ideal for you. So there is a prepayment risk for the holder of these packages of bonds or tranches of bonds. Okay, so where are we with time? 16 minutes. I'm going to try to keep it tight and crisp. I always say that, and I never really do it, but I'm going to make a best effort to do that. Okay, so we have a few more features: interest rate sensitivity, credit divided by amount of the annuity that comes to us in the raw data, and the amount credit I think was given to us, right? And this was derived. So anything that I'm calculating pretty much has upper and lowercase letters. Anything that's given originally has all uppercase letters. Okay, you can see all these are all uppercase. And that's just a convention I came up with. You might want to keep all of these uppercase just to prevent some errors from being made, because this is case sensitive. So if you had the same column and it's called interest rate sensitivity with the underscores, it's all uppercase, that's a totally different variable from this variable right here. Okay, in the Python world, we deal with case sensitivity, and that's just the way it was designed. So I can see which features I created by using upper and lowercase, but if you want to be consistent, you might want to use all uppercase. Okay, really personal preference. It doesn't really matter. Everything works fine here. So here, Control Enter to refresh this. We have the annuity, interest rate sensitivity, prepayment, and adjusted cash flow. So let's look at a couple other metrics here: probability of default, loss given default, and exposure at default. Now I have a whole video dedicated to just these three metrics, so you can check out that video if you find this interesting. But that is the probability of maybe the borrower defaulting on the loan. You get, let's just say, for sake of argument, $1 million, buy a nice condo or a mansion. In New York City, you can buy a studio for $1 million. If you're in the Midwest, you can probably buy a 5-bedroom house for $1 million, depends where you are. Let's say you buy the thing and you pay for 1 year, then you decide you're not going to pay anymore. The person could default on the loan. This is the probability of default. We're measuring that. And the loss given default, if the person does default, how much you lose. If they already paid 1 year of interest payments and principal back, then you could only lose 29 years, right? Still a lot, but you got some of it back initially. But the loss given default is if the person defaults, what is your total loss there? Okay, and it's not everything, right? Like if you have the property as collateral, normally the bank will. Like I can't imagine them issuing a loan without tagging the property as collateral. You could go ahead and sell that house, and you could probably get most of it back. Now the bank will have to go through a foreclosure process and maybe put a lien on the house, and they're going to have to go to an auction and sell it. So you're probably not going to get the market value. So it is a loss, but it's not a total wipeout. You could sell the property based on the collateral value or the intrinsic value of that house or the condo, whatever the thing is. Exposure at default is another metric. Value at risk is another simplified risk calculations. We have all these down here: LGD, EAD, VIR. So give you that stuff. And that looks like, wait a second, something looks a little bit like it got wiped out, because I think I was running too many things in my notebook here. And got purged from the memory or something. That was weird. Okay, I think it's back. Okay, it's back. So we're good now. Borrower is likely to have had a credit history since starting employment. So that's what we saw before. Days employed. Are there any late payments? We need to know about that. Credit score. Again, we have to drive that because it's not given to us. Let me go ahead and refresh it. So it should be fine, even though we couldn't see the view. It's still preserved in memory. Thank you, Jupyter Notebook, for doing that for me. So we have the original features here, all in caps. These are the ones that I calculated. So debt to income, you want this to be smaller. If you have huge debt and small income, it's not great for the lender. If you have small numbers here, it's better. Loan to value, and higher, the lower in this number, then the lower in this number. This is higher, right? You can see the relationship, 4.2, 0.8. This is 2.0 and 0.4, right? So those are always going to be relative. Credit score, these are pretty high. I think it goes up to 850 and down to like 350 or something, whatever that is. What was that range? Oh yeah, 300 to 850, right? So this guy you probably don't want to lend money to. This guy has solid credit. That's probably Bill Gates. This is some guy that has no credit, okay? So we have that. We have all the notes in here. I'm going to move on. We're 21 minutes into it. I don't want to suck up all your time, but I do want to deliver the message here. So we have some NANDs. We have to handle that to go ahead and run our next model here. So we are calculating the NPV, the net present value. We have a discount rate. I have a whole video on NPVs, IRRs about financial modeling. So take a look at that when you have a chance. I think it's very interesting, insightful. You could get a lot out of that. If you're interested, if you are compelled to do that, right? Okay, and we know the NPVs of all these loans. The net present value is the value today discounted back over time. What is this investment worth today? So we always want to look at current values given the interest rate over time and project this into the future. What is something worth in the future? And we want to know about that, but what is it worth today after accounting for all the discounting steps? And this could be 2 years, 5 years, 10, 20 years. I think I heard of even a 50-year mortgage. That is not very common at all in this country. Some countries only give you like I think a 3 or 4 or 5 year mortgage. In Canada, it's pretty short. In the United States, we get up to 30. I think you can get a 50 in some places, but you're going to pay an arm and a leg for that, probably for the opportunity to pay less per period. But then the total amount that you pay over the lifetime of the mortgage is going to be much longer too, or much greater too. So you have to be aware of that. But the NPV compares everything to a baseline today. What is that item worth today? The net present value. We're looking at the loan rate, the annuity, and amount of credit divided by the annuity, okay, to get the relative percent there. This is going to give us the yield spread. And then one more metric is the weighted average life. So I Googled this and figured out how to create the user-defined function. I'm not super familiar with WOW, whatever it is. But apparently this is a metric that they use in the mortgage analytics business, right? So now we have these three. NPVs are very common, and the loan rate and the yield spread. I've seen that all over the place. The WOW is a little bit new for me, but whatever. That is what it is. So we have some negative NPVs, and that's fine. These are typically negative. It's money going out if it's negative. Money coming into you is positive. The loan rate here is basically, let me take a quick look at that. How do we get that? Oh, annuity times the credit divided by annuity divided by the credit. So I found that online. Annuity times the number of periods. So like a 30-year mortgage would be 360 divided by the loan amount. Okay. So we calculated that. Predict prepayment risk. Okay, so I set up a machine learning model to look at the prepayment risk here. This is a label, and either there is a risk or there's not a risk. Okay, so when you're working with random forest regressors or XGBoost regressors or any kind of regressor, you're looking at numerics. If you're looking at a classification problem, that's going to be binary, yes or no, true or false, good or bad, on or off, things like that. Or it could be a label like size of a shirt. It could be small, medium, large, extra large, double XL, triple XL, right? Anything that's not numeric is going to be a classifier. That's why we're using this technique right here, random forest classifier. And log regression is actually a classifier as well. It sounds like a regressor, but it's actually a classifier. But again, if these were numeric data points, we would be looking at a random forest regressor. Okay, this is either risk or no risk. Prepayment risk, that's what we're looking at. So this is a label, it's going to be 0 or 1. 1 is risk, 0 is nothing. Okay, 1 is always true, and 0 is false. 1 is something exists, and 0 is doesn't exist, right? So there's no risk. So we're looking at the overall prepayment risk for each one of these investors for the entire portfolio, right? And we are going to go ahead and put this into a machine learning model right here. And I've got several videos on this. So these are the independent features. X is the independent features. You can see it right here. So debt to income, loan to value, amount credit, annuity, affordability index, and estimated credit score. So these are the features we're looking at. And this is not like the gospel truth here. You could add a couple more features to this to make the analysis more comprehensive. I think this is a good starting point. Definitely a good place to start a conversation. If you talk to some people on your team or your quant team or your trading team or something like that, and they say, okay, I want to see a couple more features to get a more comprehensive understanding of the prepayment risk here, then by all means you can add in new features, right? I just picked this to begin with, and this is the dependent variable. So we want to go ahead and predict prepayment risk. So the Y is a dependent, and this is the independent. And of course, you can have one independent. That's a little bit unusual. You usually have multiple independent. Okay, and you always have one dependent. You will never have more than one because you're trying to predict the outcome of some feature, right? Or some column. They're called columns in a data frame. In the machine learning world or data science world, they're called features. Okay, and we've got the output. Good. So the model is 99% accurate, 99.96%. So very accurate. This is 0, no prepayment risk. This is 1 prepayment risk. We have the total number of features. You can sum this up. We look like 19 and 41,000. So was that 20 plus 40, about 60,000 or so? Yeah, just about 60,000 records here. And we can see precision, recall, and F1 is very high right here, all 1.0. That's exactly what you want. The model might be a tad bit overfit because the accuracy and precision and the F1 score is almost a little bit too good to be true. I did not run a analysis or did not do a test to see if the data is overfit, but it's pretty comprehensive and pretty diversified over here. Like if we had huge concentrations of data points, I'd be a little bit more concerned. I would say intuitively it's probably not overfit, but you could run the test just to prove that. The number does appear to be very high, so it could be, but I don't think in this data set that's really a major concern. But that is one thing we could do an initial test for. It's so much packed in here already. It's a little bit overwhelming, so I just didn't add in one more thing to be concerned about. So here we can do a scenario analysis where we're looking at a bunch of different outcomes, but we're focusing just on these features right here. So if you did a scenario analysis on every single feature here, remember we had 122, we would have a huge report. I did this yesterday. It came out to be so overwhelming. I couldn't even understand what it was. And it took this slider control over here and made it like a little tiny sliver. It looked like a kind of like a toothpick or something. And we had a huge report. It was so much I couldn't even understand or internalize or comprehend what was going on. So I got rid of that. I just started to focus on these 1, 2, 3, 4, 5, 6, 7 variables. If you look at all 122, I think it's going to be to your detriment, more to your benefit, because it's going to be so overwhelming. You're not going to understand what's even going on. But we're looking at min, max, mean, which is the average, and the standard deviation. And we're focusing just on these 7 features right here. So I think that is fine. We have the scenario analysis. We're going to do one more simulation analysis. This is a Monte Carlo simulation. Control Enter to run it. We're running 10,000 simulations and looking at interest rate sensitivity. That is interest rate sensitivity that I calculated initially. You always start with the mean and standard deviation for these things. So in portfolio management, you always see the mean of each stock's return and standard deviation of each stock's return and a contribution to the whole portfolio. In A/B testing, it's the same thing. You look at the mean and standard deviation or the variance of the different campaign. So in A/B testing, how much you invest in a certain product or a certain feature of a product or something like that. What's the mean? What's the standard deviation? If you invest more and more, is the payoff higher and higher? Or if you invest more and more, the payoff is actually lower and lower. So you don't want to do that, right? So these mean and standard deviation metrics are very common. You see this all over the place in all different facets of different industries and businesses. So again, we're looking at the default risk. We're again taking the mean and standard deviation. Okay, you see us all over the place in the business world. We create the simulation analysis. We look at scenario analysis over here, right? So we have a couple different scenarios. Here we looked at 10,000 different simulations to see how things shake out, and this is the distribution. We can see the portfolio loss or profit is going to be over here, simulated losses, the maximum loss we can expect, and the 95%, 95th percentile is actually, let me see if I can click that off. Yeah, so you can actually click these off and click these on, and it will show up or disappear from the graph, and you click that, and the whole thing goes away, right? So this Plotly chart is very interactive. You can zoom in, zoom out, pan in on these different things, right? You see the outcome of that, double click to go back to the original, and you can see the maximum loss here for the portfolio is like 650K, and the minimum down here would be like 300K. That would be like the worst case scenario, but for the most part here, this portfolio is going to be profitable as long as we, go back to the beginning here and pick and choose our risks appropriately, right? So, like I showed you before, look at high risk profiles, right? For customers, we want medium risk or low risk. So any high risk should probably be kicked out right there. That's why we're probably losing some money. Prepayment risk and default probability. So you want to make sure these are low, right? So those are still in the portfolio. By the way, I didn't kick them out. Probability default, LGD, EAD, VAR, those are all in the portfolio. So if we start excluding all those, then the amount that we risk at the end here, the Monte Carlo simulation, is going to decrease substantially. We're getting rid of all the bad loans or the potentially bad loans. But you don't know for sure. That guy that could be a high probability risk could pay off the mortgage in full, and you can make a lot of money on that guy, right? So there's two ways to look at that. You can be very conservative in who you issue loans to and say, okay, I'm going to accept virtually no risk, and you're going to make no profit, by the way. Okay, if you do that. And you can say, I'm going to accept every risk in the world, and I'm fine with it. I'll get enough good risks to offset the bad risks, and that's fine. You'll probably do okay, but you're still going to have a lot of bad potential risks on your books. You don't necessarily want that. So you don't want to extend loans to every Tom, Dick, and Harry that comes around, and you don't want to exclude everybody that comes around because you'll make no money. If you give loans to everybody, you're going to lose more than if you pick the the low credit risks and the low default risks. So that's what all the previous steps were for. Okay, so we have the comprehensive portfolio here. We didn't kick out the risks. Probably should do that, but this is just a holistic view of everything. So that's it. Went over 30 minutes, just a little bit. Here's some notes here for lenders. We want to attract the best borrowers. That's what I just mentioned, while ensuring profitability. So you can give loans to everybody. You're going to have some bad loans on the books, and you're going to have some losses. You can give loans to nobody, but you're not going to make any money at all. Okay, you're going to have zero income for the year. Try explaining that to your boss. Good luck. Identify high-risk loans and set appropriate reserves. Optimize loan terms for investors. Evaluate the fair value of the mortgage rate, mortgage-backed securities, MBS. Assess prepayment risk and default risk to price the MBS accordingly or appropriately, and use interest rate derivatives to hedge risk exposures. That's a whole nother lecture. Maybe I'll do one like that. But this 30-minute lecture would blow up into a 60-minute lecture in a blink of an eye, and we're not going to go down that path right now. So maybe in the future, but not today. So that's it, pretty much wrapping up. Hopefully that was useful, insightful, and interesting to you guys. I always like to do these exercises and share my findings with you and drop some knowledge at the same time. I'm going to wrap it up right here, right now, and I will see you guys in the next video.